But look at the rates. Which ones are high? To 30 years up top. So it's demanding over 5%. Your mid one is what,
10. Yeah,
I can't see
4.48.
it.
4.48%.
But then the short term is under 4. So it's saying, what's the bond market telling you? Short term, it thinks you can pay it. Midterm to long term, the risk is higher, so the rates are higher or the yields are higher. The buyers of those bonds want more return on the price.
Which is the way it should be.
Right. But
Yeah.
that tells you that there's a long-term problem in your debt market.
Which is why they're buying bank CDs, correct, Mike? Instead of
That's
treasury.
the short terms. Yeah.
Yep.
These are going to be your 2 years and under.
Right.
You know, basically it's a zero coupon. They're going to take, a broker would use zero coupons and strip out the interest.
Yeah, Margaret and I looked at, I know we bought, the Treasury bill 30-day was 4.27, and we found a CD at 4.35,
Right. Well, the CD was how long?
30 days.
30 days.
But it beat out the Treasury bill, the 30-day Treasury.
Right. Because the CD was more than just treasuries.
Yeah.
It's probably, a multiple debt instruments in there.
Yep.
Might
Still
have short-term
30 days.
commercial paper or something like that as
Yeah.
part of it.
Yep.
I think that's a good point. The underlying asset of a CD can be multiple
Yeah.
different
Same thing with the money
assets.
market.
But it's insured up to $250,000.
Yeah.
But Mark, that really doesn't matter in the grander scheme of things. If the bond market blows up, you think that they're going to have the money to pay you in the
Well,
insurance?
if the bond market blows up, that's the least of my worries because everything's going to blow up.
Yeah, but you're not going to get that 250K insurance.
I'm just saying
Why? Because it's
I'm
based
I'm
upon
looking
these
at it.
bonds.
I'm looking at if the bank has an issue on its own without the bond market blowing up, you're insured, like Silicon Valley. Okay.
Yeah.
They were in the wrong bonds. They didn't have enough liquidity.
Well, they
Doesn't
were
matter if
underwater.
you're buying
Yeah,
treasury.
they were
Which
underwater on their
treasury?
bonds. Yeah.
How
They
much?
I
had
think that brings up a good point is when you find a bond, mutual fund, or ETF or CDs that have over and above yields on them, you have to question what the underlying assets are, because it could be a higher risk assets that could have a higher probability of default. So when you're looking for that kind of thing, if it's abnormal, then it's probably something wrong with it.
I think
There's more risk in it.
There's higher risk.
I think there's, unless, like Mike said, the bond market blows up or the world goes to hell, you're still insured up to $250,000 on a 30-day CD. If the bank has a problem, okay, sure, you'll be insured. Unless the whole system blows up, then we have bigger issues. So, I'm not too worried about a 30-day CD from a bank, and 4.35 to 4.27 isn't hugely different on a 30-day. So I'm not too worried about it, because of that.
But the emphasis is on the duration. You're looking at 30 days.
They're both 30 days. Yeah.
Versus the 5-year CD they're trying to sell you.
Yeah, I don't have any long-term debt other than 30 days, either treasuries or CDs. That's it.
Yeah. Yeah.